So you just saw some crypto and now you're wondering, how do I report this on my taxes? Well, in today's video, I'm going to be explaining all things Canadian crypto taxes and what you should know. Hi, welcome to my channel. My name is Irene and I'm a CPA here in Canada. I post videos explaining important accounting concepts using simple language to help Canadians better understand accounting and taxes. Make sure you hit that like and subscribe button for more. The CRA does not view cryptocurrency as a legal tender. Instead, cryptocurrency is treated like a commodity for Canadian income tax purposes. The income from crypto activity can be taxed as either business income or capital gains, depending on your circumstances. We'll get more into that later on in this video. Let's first take a look at what triggers a taxable event. CRA uses the term dispositions to refer to some of these taxable events. The following transactions are when a taxable event occurs or when a disposition occurs. So whenever you sell crypto, when you give crypto, when you use crypto to buy a service or a product like NFTs, when you convert crypto back into fiat currency, when you swap one crypto for another type of crypto. Some other sources of income from crypto activities that's not listed directly on the CR website include rewards from staking and yield farming. In contrast, the following transactions are non-taxable events. So the first one is when you buy and hold. So yeah, when you simply buy and hold your crypto, there is no taxable event here, nothing. It's only when you go to sell or do something with it. The next one is when you transfer cryptocurrency from exchange to exchange or wallet to wallet. So let's say I bought some Ethereum on the exchange and I wanted to transfer that into my offline wallet. That transfer is not going to have any taxable event, no tax impact, because I'm simply just moving the crypto from one place to another. I'm not really disposing of it or like getting rid of it for something else. So now that we know what will trigger a taxable event, how do we differentiate when the income should be treated as business income or capital gains? Well, this is a very, very important distinction because if treated as business income, it'll be taxed at 100%, while if treated as capital gains, only 50% of the total gains will be taxed. CRA considers crypto trading, crypto exchanges, and crypto ATMs as cryptocurrency businesses. CRA also can consider mining as a crypto business. However, if it is determined to be a hobby, then not. In the eyes of the CRA, they will view these patterns as signs that your crypto income should be treated as business income. So for example, the frequency of your trades as well as the repetitiveness of these transactions. So let's say you're buying and selling in the same day all the time, then that could signal that it is business income and you're trying to gain a profit. Another sign in the eyes of the CRA that your crypto income is business income is if you are promoting a product and or a service and you carry out the activities for commercial reasons. Another sign that your crypto income is business income is that if activities are carried out in a very business-like manner. So for example, you treat crypto as more of an inventory that you see to sell for a profit rather than as an investment to hold and realize appreciation on. So if your patterns of your transactions don't really fit these signs that I've talked about, then using capital gains treatment can be appropriate. So after you've determined the type of tax treatment for the income, we're going to take a look at a really simple example to see how we can calculate the income amount. So you're going to need to know the cost of the crypto when you initially purchased it, and then you're going to also need to know the fair market value as at the day and time when the taxable event occurred. So let's say you bought Ethereum at $2,000 and many months later you decide to sell it for $4,000. When you subtract the proceeds of $4,000 by the cost of $2,000, you're going to have a net increase of $2,000. So if this was considered business income, your $2,000 income is going to be added into your personal tax return so that it could be taxed at your marginal tax rate. However, if this was considered a capital gain instead, only 50% of that is taxable. So what that means is only $1,000 of that $2,000 gain is going to be added into your tax return for it to be taxed at your marginal tax rate. So now if the reverse was true, let's say you actually bought the cryptocurrency, the Ethereum, at $4,000 and you eventually sold it for only $2,000. So now your proceeds were less than your cost. So now you are kind of at a loss. So if this was considered a business loss, your $2,000 loss can be used and applied against any other income that you have, which will bring down your total taxable income and make your overall tax liability less. However, if this was capital loss, only 50% of that loss, which is going to be $1,000 here, can be applied against other capital gains to reduce that. You cannot use capital losses to offset other sources of income, like employment income if you had a job. If in the year you have capital losses and you don't actually have any other capital gains from your other investments, and so that means you won't be able to offset your capital losses. And what's going to happen is those will be carried forward into a future year, which you can be using it when you have capital gains to use. And then to add on to that, if you had capital losses in the current year and you don't have any capital gains in the current year to offset, however, if you had capital gains in the previous years, then you can also carry that back if you wanted to. So the same calculation is used when you are calculating another disposition. So for example, when you are swapping cryptocurrency, you're gonna have to make note of the fair market value cryptocurrency as at the day and time of the swap, the taxable event. And you're gonna use that fair market value as the proceeds of your disposition. And that is what you're gonna use to calculate your gains or your loss. Some other information and records that you need to keep books of when reporting these types of transactions include the date, the receipt, the amounts, the digital wallet addresses, a description of the transaction, and if applicable, software costs, accounting costs, legal costs. So just now I gave you a super simple example. However, it's not always that simple, right? So let's say, for example, you did buy one Ethereum for $2,000, as we previously said. Let's say the market kept dipping and dipping, and you decided to buy the dip. So then you go ahead and buy another Ethereum, right? And this time you get a steal. You buy the second one for $1,000. Okay, so now you have two Ethereums and the total value is $3,000. So now your adjusted cost base is going to be $3,000 divided by two Ethereums, right? And so now each cost base is going to be 1,500. And that is what you're going to use to calculate your other gains losses. And so as you buy and sell more, the adjusted cost base is going to change every single time. So it can get very complicated very fast. So it's really important to stay very organized and on top of it when it comes to your crypto. And so some ways to track this is that you can do it yourself on an Excel spreadsheet where you will list out the transactions and then calculate the adjusted cost base each time you buy and sell. Or you can also just export some information from your exchange and then manipulate the data to get whatever information you need. And then another option is that now there are also going to be crypto tax softwares where they will allow you to basically extract all the data from all the exchanges that you use or the wallets, and then they will just automatically calculate it for you, as well as all your gains, losses, and such. I personally have never tried any of the crypto tax softwares. I just wanted to bring it up here so that you know what is available on the market. You could do your own research. I think some of the popular ones is Coinly as well as CoinLedger. So because crypto is still relatively new, there's still going to be a lot more news and information to come about crypto, and because the industry is always evolving and changing as we speak. At the time of this recording, the registered accounts like TFSAs, RSPs, you're not able to actually directly buy the cryptocurrencies. However, if you do want to partake in those accounts, then you can buy crypto ETFs. So with everything that's going on in the crypto market now, please remember that if not your keys, not your crypto. If you're looking for a cold storage offline wallet, I have linked my affiliate link down below with Ledger. It's one of the most famous cold storage wallets out there. Just make sure you protect your assets. I hope you found today's video helpful. Again, I post videos every single week breaking down accounting and tax concepts using simple languages. Make sure you hit that subscribe button for more. Thank you so much for making your way to the end of the video. Here is a video that YouTube thinks you're really going to like, and I will meet you there.